Greetings, and welcome to Stratasys second quarter 2020 financial results call. At this time, all participants are in a listen-only mode. A question and answer session will follow the formal presentation. If anyone should require operator assistance, you may press star 0 on your telephone keypad. As a reminder, this conference is being recorded. I would now like to turn your conference over to Yonah Lloyd, Vice President of Investor Relations.
Good morning, everyone, and thank you for joining us to discuss our 2020 second quarter financial results. On the call with us today are our CEO, Yoav Zeif, and our CFO, Lilach Payorski. I remind you that access to today's call, including the prepared slide presentation, is available online at the web address provided in our press release. In addition, a replay of today's call, including access to the slide presentation, will also be available and can be accessed through the Investor Relations section of our website. Please note that some of the information you will hear during our discussion today will consist of forward-looking statements, including, without limitation, those regarding our expectations as to our future revenue, gross margin, operating expenses, taxes, and other future financial performance, and our expectations for our business outlook. All statements that speak to future performance, events, expectations, or results are forward-looking statements. Actual results or trends could differ materially from our forecast. For risks that could cause actual results to be materially different from those set forth in forward-looking statements, please refer to the risk factors discussed or referenced in Stratasys' annual report on Form 20-F for the 2019 year, as well as Stratasys' reports on Form 6-K that we are furnishing to the SEC today, including the related press release concerning our earnings for the second quarter of 2020 and our operating and financial review and prospects, which are attached as exhibits to those reports on Form 6-K. Stratasys assumes no obligation to update any forward-looking statements or information which speak as of their respective dates. As in previous quarters, today's call will include GAAP and non-GAAP financial measures. The non-GAAP financial measures should be read in combination with our GAAP metrics to evaluate our performance. Certain non-GAAP to GAAP reconciliations are provided in the table contained in our slide presentation and in today's press release. Now, I would like to turn the call over to our CEO, Yoav Zeif. Yoav?
Thank you, Yonah. Good morning, everyone, and thank you for joining today's call. As I mentioned last quarter, my first month as CEO have been spent carefully reviewing all aspects of our business in order to improve the corporate strategy. The COVID slowdown has, on the one hand, created a short-term challenge for the business, and we will discuss the measure we have taken to address that. On the other hand, it has created more opportunity to focus on this critical exercise, to better understand our key growth levers and strengthen the foundation that will help position us for long-term profitable growth. The largest opportunity for us in 3D printing is in polymers, and the fastest growing area is manufacturing. We are already a leader in this market and expect to increase our presence through new offerings that will focus on delivering incremental customer value to this sector. I will first go over the current state of the business and then share details regarding our new strategy. Our second quarter results reflect the impact of a full quarter of COVID-19, with revenues challenged by a weak macro environment and a pause in capital investment worldwide. Cost mitigation has been a universal business priority, which naturally impacts the purchasing activity of our customers. In addition, printer utilization and therefore material usage was low, as many users across our install base were not working on site. We also continue to implement measures to manage costs. Most of our employees worked from home this quarter, and we applied a 4-day work week across the company. On top of that, our executive team took an additional 5% salary reduction that will last through the end of the year. In early June, we announced a reduction in force of approximately 10%. As a reminder, this resizing was already a planned part of our new operating model, designed to reduce operating expenses as part of a cost realignment program to focus on profitable growth. The implementation was accelerated due to the COVID situation. On the last call, we highlighted some of the many COVID-related initiatives where Stratasys led our industry in helping the global medical community address the various equipment shortage they experienced. These activities continued throughout the second quarter, and many are ongoing. We are very proud of the positive impact Stratasys has had in helping address the medical supply chain crunch that happened due to the COVID. And we see this as an opportunity to educate the market on the benefits and value proposition of our technologies. Despite the slowdown due to the COVID, we remain very optimistic about where our business and our industry is headed. Our engagement level with our customer remains high, and the demand for additive manufacturing solutions continue to grow. 3D printing is penetrating further into manufacturing across every relevant business sector. In fact, as we stated last quarter, we are seeing business and governments reassessing their supply chain and implementing decisions that will drive increased demand for 3D printing as strategic imperative, leading to additional business opportunities for Stratasys. Localization and the need for increased self-sufficiency are both on the rise. Among the many benefits that are creating a greater need for manufacturers to seek 3D printing solutions. An April study by the Society of Manufacturing Engineers of 700 U.S. manufacturing professionals found that 25% of them were planning to change their supply chain in response to the pandemic. 3D printing ranked number one, along with robotics, as their top choice for post-COVID investment out of 11 technologies, ahead of such innovations as 5G, artificial intelligence, and digital security. The companies surveyed range across industries, including aerospace, automotive, consumer products, defense, industrial machinery, dental, medical, and education. Here is further evidence of growing interest. In May, a new bill was introduced in the U.S. House of Representatives called the Advancing 3D Printing Act. The proposed legislation would require the Consumer Product Safety Commission to undertake a study to assess the state of the 3D printing industry. It would include evaluating solutions to secure the supply chain and the appropriate federal role to increase and facilitate 3D printing, manufacturing, and innovation. To quote Congressman Michael Borges of Texas, 3D printing may account for up to 10% of U.S. manufacturing in the future. We believe in this visionary statement, and Stratasys has been actively engaged in Washington to help make it happen. We had meetings with bipartisan members from relevant committees of the House and Senate in late June. We will continue working with legislators to help educate and guide them as they learn more about implementing the many benefits of additive manufacturing. And key customers of ours are seeing these benefits with Stratasys every day, as illustrated by the recent announcement we have made with BAE Systems, a leader in aerospace and defense industry, and General Motors in automotive. BAE continued to add its portfolio of F900 printers, making Stratasys an integral part of their Factory of the Future initiative. And late last year, GM added 17 production-grade FDM systems to its Stratasys portfolio as the company expanded its additive efforts from prototyping to the production of tooling such as jigs and fixtures to be used on the factory floor. The additional Stratasys printers were placed in a new multi-million-dollar additive innovation lab in Michigan. In March, GM was contracted by the U.S. government to help produce 30,000 ventilators. By August, to help support COVID-related needs. All of the 3D printing tooling for this project was manufactured on Stratasys systems. I am also very proud of our team that despite the challenges of COVID, we were able to begin the commercial production of our new Polyjet J55 in the second quarter, which began shipping in late June. The J55 is an exciting and highly innovative printer for the design community that brings most of the features of our premium Polyjet technology into an office-friendly system, featuring a unique patented turntable format. Market response so far has been solid. With 313 million in cash equivalents, and short-term deposits, and no debt, our company is healthy and able to take advantage of opportunities in the market. Even with the revenue challenges this year, we have been able to manage our strong cash position, demonstrating the resiliency of our business model. Now let's talk about our strategy going forward. When I started as CEO in February, my mandate was clear: to reverse the declining top line and position Stratasys to return to growth as the additive manufacturing leader, period. We embarked on a deep internal and external evaluation to develop a clear strategic direction that we have already started to implement. To better position us for long-term growth, we formed an analysis team representing every aspect of our company, and we undertook a thorough diagnostic and strategic assessment of both our business and the market. The objective of the strategic review was to determine the action necessary to leverage our core competencies and double the size of our business, while strengthening our leadership position and becoming the industry's first choice across a broader range of solutions. I am excited about the results of our analysis. The market overall is growing and is expected to grow further, dominated by polymer, the largest value pool. This is consistent with what we are hearing from our customers, that there is greater interest in using 3D printing to help them be more responsive in an increasingly uncertain world. From bringing new innovation to market faster to creating more adaptive manufacturing lines and supply chain. Specifically in polymers, our areas of expertise, we see significant opportunity to deliver incremental customer value, especially in the fast-growing manufacturing applications, where we see the longest runway for growth through new technologies that we will offer. We will pursue the right technologies to supplement our portfolio that will help us to address this application and achieve our goals. It is also clear to us that the competitive landscape and market offerings are fragmented. There is no silver bullet additive manufacturing technology, material or application, and no clear leader across all major segments of our industry. Market leadership will be achieved by the company with the most comprehensive solution set, with the widest scope of technologies to address multiple attractive growing segments, supported by industry-leading go-to-market and global service infrastructure. We believe that Stratasys is that company and can be the first choice for polymer application across the industry. We also believe that we have a most trusted reputation for high quality, reliability, and service, which serves as a vehicle to support our customer and help capture the growth. So let me share the framework and key concepts that will drive our strategy going forward. To expand the range of our technology portfolio to include the faster growing solutions that will help us achieve our objective. Stratasys today leads the industry with the largest share in material extrusion and material jetting through our FDM and Polyjet technologies. However, these two technologies currently address only about 1/3 of the total additive manufacturing hardware opportunity. Further, their growth rates have slowed in comparison to the growth rates of other technologies that suit the needs of faster growing applications, especially in production. We have already started the journey into true manufacturing, evidenced by our experience in our existing high-end FDM application, including end-use parts, and our leadership position in the high-standard aerospace sector. For example, there are over 100,000 polymer parts flying today that have been printed on Stratasys systems. And as we are witnessing continued expansion in manufacturing application, there is still plenty of growth opportunity also in prototyping. Therefore, to help us win these faster growing areas, we will invest organically and inorganically in new polymer technologies such as powder bed fusion, VAT, photopolymerization, and others, which will help us generate more opportunities with new offerings to better meet the market demand. As an example, we have a joint venture with ZAR called ZAR 3D, co-developing a powder bed fusion production grade system. This expansion will help us address additional manufacturing-focused customer applications, while leveraging our extensive infrastructure and core competencies of the strongest go-to-market vertical industry knowledge and experience, the largest install base, the best reseller channel, and the deepest polymer additive manufacturing know-how. We have the proven experience to grow with our customer throughout the adoption lifecycle of their journey in polymers. We believe that leveraging these core competencies across all of these technologies that will be in our portfolio will convert the addressable opportunities into increased revenue and profitability. And introducing the technologies to open up more applications can better serve both our current and potential new customers, grow the overall opportunity, and more than double our addressable market. In addition, there will be an operational model change to ensure the success of our strategy. Those changes are still in process, so I will share more details on new operating model at a later date. I will now turn the call over to Lilach, who will share the financial results of the quarter. Lilach?
Thank you, Yoav, and good morning, everyone. Total revenue in the second quarter was $117.6 million compared to $163.2 million for the same period last year, a decline of 27.9%. GAAP operating loss for the quarter was $29.3 million compared to operating income of $0.8 million of the same period last year. Non-GAAP operating loss for the quarter was $8.1 million compared to operating income of $9.1 million for the same period last year. GAAP net loss for the quarter was $28 million or 51 cents per diluted share compared to net income of $1.2 million or 2 cents per diluted share for the same period last year. Non-GAAP net loss for the quarter was $7.4 million or 13 cents per diluted share compared to non-GAAP net income of $8.5 million or 16 cents per diluted share reported for the same period last year. Product revenue in the second quarter was $73.9 million, a decrease of 33% compared to the same period last year. Within product revenue, system revenue decreased 35.6% compared to the same period last year. Consumable revenue decreased by 30.6% compared to the same period last year. Service revenue was $43.7 million, a decrease of 17.2% compared to the same period last year. Within service revenue, customer support revenue decreased by 7.5% compared to the same period last year. GAAP gross margin was 37.2% for the quarter compared to 49.7% for the same period last year. Non-GAAP gross margin was 45.4% for the quarter compared to 52.5% for the same period last year. The decline in gross margin is due primarily to the lower proportion of consumable out of the total revenue mix. As we noted on our last call, we expected a continued sequential reduction in the gross margin for this quarter. In addition, operational inefficiency had an impact given that last year we proactively built inventory and operation costs were in efficiency mode. But now, due to the low revenue and lower production level, it has the opposite effect, so the delta between the quarter is even more notable. We are confident that gross margin will recover as our customers return to their pre-COVID utilization levels. GAAP operating expenses were $73 million, down 9.2% compared to the same period last year. Non-GAAP operating expenses decreased by 19.8% to $61.4 million for the quarter as compared to the same period last year, driven by proactive cost-cutting measures in SG&A. Examples of this include almost no travel during the quarter and no trade shows. Most employees are working from home, which reduced maintenance and related costs. There has been no essential position hiring freeze. Everyone has been effectively reduced to an 80% work week, and the executive team has taken an additional 5% pay cut on top of that. Additionally, there was a partial impact of the resizing plan that started in June. A working assumption is that COVID-19 will continue to weigh on the business at least through the end of the year, so we plan to maintain these cost-cutting measures. Regarding R&D, I would like to point out that while this expense declined both sequentially and year-over-year, it was primarily due to the impact of the reduction of our work week to 80%. We selectively applied the R&D cost control to ensure that the NPI program were not affected, and we plan to continue investing as needed in order to support our new product development program. The company used $9.7 million of cash from operation during the second quarter, as compared to $3.8 million of cash used in the same quarter last year. We ended the quarter with $313 million in cash equivalent, and short-term deposits, compared to $325.5 million at the end of the first quarter of 2020. We believe that we are well prepared to manage the COVID-19 situation with a strong balance sheet and no debt, while focusing on cost control and cash generation. Regarding guidance, the next few quarters will continue to be unpredictable, and visibility will be limited due to COVID-19. Therefore, we are continue the suspension of full-year guidance until the economic environment stabilizes. Appropriate reconciliation between GAAP and non-GAAP financial measures are provided in the table at the end of our press release and slide presentation, with itemized details concerning the non-GAAP financial measures. I would like now to turn the call back to Yoav.
Thank you, Lila. To sum up, we believe the value proposition of 3D printing is more compelling than ever to the manufacturing industry. Even in fact, especially in light of the uncertain global environment we are in today. We believe we have the ecosystem, resources, and strategy to be the leader in polymer additive manufacturing for all of the key growth areas: design, engineering, manufacturing, and healthcare. With the strongest and widest portfolio, supported by the best sales and service infrastructure, we will enhance and broaden our technology offering to serve significantly more applications and offer full suite of solutions, systems, materials, software, and service, combined with the capability to rapidly expand applications with our wide array of technologies. We are confident that this effort will reboot growth in the short to medium term, provide us with access to a greater customer share of wallet, and drive our top-line growth in the future.
Operator, please open the call for questions.
Thank you. At this time, we will be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. One moment, please, while we poll for questions. Our first question today comes from Shannon Cross of Cross Research. Please proceed with your question.
Hi, this is Ashley Ellis on for Shannon. Yoav, you provided a lot of detail on the polymer market and manufacturing, which was very helpful, but I'm wondering, as you think about the polymer strategy, where does your metal technology sit in that? And then similarly with the manufacturing market, MakerBot, you have some desktop systems for engineers, but I'm just wondering how that business kind of benefits the manufacturing market. And then I have a follow-up. Thank you.
Thank you. So let's start with the metal. We are here to, gear the company for short and medium level growth and making sure we are maintaining and strengthening our polymer position, period. But we have metal, we have the LPM, but it's in a nurturing stage. And we are really exploring our best way to move it forward. It serves different customer base, it has a different value proposition, and it's still in a nurturing incubation stage, and it will not be the one that will generate growth in the short term. So we are exploring it, and we'll update on it in the future. Now for MakerBot. By the way, on metal, we are one of the largest leaders in metal manufacturing with our SDM, and we are well known for our quality of parts. That will keep running, but that's on the part side. As for MakerBot, when we are saying this is a fantastic example for the advantage of focusing on polymers, because we start with MakerBot with engineers, and then we take it through the life cycle of the part, from the design through the functional engineering phase of developing the product through the production. And what we are doing with MakerBot, where we have significant competitive advantage in terms of our new offering, which is a heated chamber, we are going to start, and MakerBot is part of Stratasys, and you will start with the same, platform and ecosystem and environment, no matter where you are in the life cycle of developing a product, from the initial design through manufacturing and production.
Got it. And then you mentioned a willingness for inorganic development, I guess in the near term or maybe the midterm. Are there any areas in particular that you're considering, and what parameters would you put in place if you were to make any acquisitions? Thank you.
As you expect, we'll not share specific details, but in general, we are looking for best-in-class technologies that will generate revenues and will be contributing to our EPS. That's first of all. And also with healthy balance sheet and the fact that we have cash and ability to invest puts us in a very good position to meet those criteria. And we're going to act, responsibly and to find those that will strengthen our position in polymers.
Thank you very much.
The next question is from Ananda Baruah of Loop Capital Markets. Please proceed with your question.
Hi, good morning. Thanks for taking the questions. Just a couple if I could. The first one would be with regards to the new strategy. You just spoke to sort of M&A a little bit. how would you guys like us to think about incremental investment, even if anecdotally and philosophically that'll be required to get the new strategy to the place you want to be? And then if you could talk about also new types of talent that you may need in that regard also. And if you could also mention what it might do to cost structure. I know you said you made mention earlier that there may be some model changes. Is that also part of the model changes? And then I have a quick follow-up as well. Thanks.
So, hi, good morning. A bit of a repetition, but we have a healthy balance sheet. We are well positioned, and we are very attractive, by the way, for many companies to cooperate with us, both on the on the M&A front, because we are bringing this huge infrastructure that we have that can leverage any technology practically in the polymer space. Because we are there, we are leading the space, and given our strong position, I would say balance sheet position, we will not compromise on best-in-class technologies, companies that started at least to generate revenues and to grow and to contribute to our operating income. That's the general guideline. As for the expenses, you want to address it, Lila?
Yeah. So obviously, when we addressed the resizing plan a few months ago, and we know what are the objectives going forward. As we mentioned, it was not because of the COVID-19. It was more from strategic perspective. We also make sure that we allow for future growth in areas where we believe they're going to be expansion and require investment. So we obviously going to balance those additional investments with priority on compromise on other stuff or setting up different priority in order to address, if needed, additional investment.
Got it. That's helpful. And so that what that sounds like to me is, there'll be additional investment, but for the most part, you'll be able to accommodate it inside of the current OpEx model. It won't, there won't be a shock to the OpEx model going forward.
Yeah. The expectations that we will, when needed.
When needed, understood. And then my follow-up is just, could you share with us any context around conversations you've had with the manufacturing industry with regards to sort of fast forwarding or moving forward some of the 3D printing initiatives? You gave some of the metrics, but I'd love to get any of the additional context from the conversations you've had over the last few months.
Nanda, just before we go to the next question, I want to clarify. It's not necessarily that we are not commentary here or providing any direction in terms of how the spending, our OpEx and spending going to look like in the future. We just say that we basically prepare ourselves to allow for additional expansion if needed, but we are not a commentary specifically now in terms of what does it mean and how it's going to look like, and specifically on any specific acquisition.
Thank you. How about manufacturing? We built this amazing infrastructure globally, which allow us or enable us to offer both system, material, software, service, around the globe. And we can do much better in terms of leveraging this system or this machine that we built over the years. And really, it's something which is unprecedented. And now we take it to manufacturing, and we are already in manufacturing because we have those FDM machines that are, repeating and are being used for end-use parts. So we build on it, but we are stepping much further than this by getting into discussion with manufacturers, producers in our key industries to make sure we really understand the needs and we tailor the technological solution for their needs. This is the advantage Stratasys has. We are the leader there. We want to make sure that we leverage this position.
Got it. Thank you, guys.
The next question is from Paul Coster of J.P. Morgan. Please proceed with your question.
Yeah, thanks for taking my question. So first up, I had the sense earlier on in the year that new products would be coming to market pretty quickly. Obviously, the J55 has been a success, but we were looking, I guess, for the ZAR high-speed sintering solution to come to market soon in a meaningful way, and also your SLA product line to be extended. Can you just comment on sort of near-term catalysts around new products?
Yeah, for sure. So maybe it's important to state, first of all, that we, with all the cost measures that we took, we made sure that we are not reducing or we are not hurting the new product introduction. That's very important to share. We already introduced the J55, which is really state-of-the-art. There is nothing even close to it in the industry in terms of design machines, or I would say advanced machine for designers. And it's in the market, and we see really good traction from design houses and whoever wants to take his design capabilities to the next level. At the same time, we have other products in the pipeline. One of them, of course, is the ZAR, and we are going to launch it. We didn't commit to a specific date, and we also mentioned the fact that we want to go out in a date where we'll be able to capture the market absorption or the market excitement, which is not exactly what we see now in the market, but we are there. It's going according. We are moving on track, and we look forward to updating you in the next call.
Okay, and I just want to reconcile two comments you made. On the one hand, the market is fragmented and sort of almost necessarily so by the combination of print engines and materials, and yet at the same time you see an opportunity to be a sort of a full scope provider of polymer-based solutions. How do I reconcile those two apparently conflicting statements?
Okay, thank you for the question. So that's exactly the reason why we want to focus, and we are focusing on polymers. It's a fragmented market. The biggest profit pool is polymer. What we know is polymers, both from the chemistry side and from the hardware side. This is our expertise. This is the deep knowledge that Stratasys developed on both sides of the ocean for the last 30 years. And now there are so many segments and applications, and the industry is an evolving industry. It's not like the car industry that, it doesn't matter if it's a Toyota or a Mercedes, it will take you from A to Z. For specific application, you need specific solution. And we have those solutions, and we will broaden it as well. And then you create this focus across the different polymer segments. So on one hand, you are addressing many of the applications. On the other end, you leverage it, and you not suffer from defocus because you leverage the same infrastructure, the same knowledge, and the same go-to-market. So, from a different perspective, I can say it is very difficult to have a scale and the advantage of scale if you are going for one application, let's say jigs and fixtures, for example, because you need to put all those people in all those countries and to support them with service, with application engineers. But if you're already there, it's just about making sure you have the right technology for the right application. And we are there, and we'll make sure that we'll be there even in a stronger way.
The next question is from Jim Ricciuti of Needham & Company. Please proceed with your question.
Question I have is just as we've started to see some of the countries opening up, are you seeing any signs of your consumable business starting to pick up in those regions where we're starting to see companies coming back?
Hi, Jim. Good morning. Yes, so definitely in definitely in Q2 we saw a reduction in almost across all industry, aero, auto, dental significantly. You probably heard it also across other sectors. So this is effectively impact the entire Q2. What we see some anecdotally indicators, specifically from dental, that they are slightly back to business, and seems like demand are picking up in the dental aspect. It's probably too early to address other area, auto. We heard that also there is some coming back, but it's probably too early to comment on that specifically. In our visibility close to the end of the year, or specifically to this quarter as well, is still remain low. But we are cautiously optimistic given what we see in the market.
Do you view the SDM business as being an early indicator of the possibly a turn in the business that might indicate a recovery in the rest of the business?
Some cases it is, some cases.
It really depends on the industry. Our part business is heavily also impacted by aero, and also from the service business, so it is impacted by that. And overflow of orders, obviously these are the first sign of the crisis was that customers are shutting down some overflow of orders. So it's too early to see whether we see some recovery coming back at the power business yet.
And lastly, just on the pricing environment, what are you seeing both on the hardware side and on the service bureau side?
Yeah, and we didn't see any significant pricing pressure. It's more about capital spending overall and shutdown of customers shutting down. So it was not about pricing pressure. We didn't see anything significantly on the hardware as well as on the consumables.
Thank you.
The next question is from Brian Drab of William Blair. Please proceed with your question.
Hey, good morning. Thanks for taking my questions. I just wanted to first make sure that I have this right in my notes. I see $30 million in cost cuts. Is that broken down roughly like 22, 23, 24 million in SG&A and the rest in COGS? Is that how to think about that for next year as a run rate?
You're right that the 30 million is across all spending function, including cost of sales as well as OPEX, and this is a annual spend, not necessarily it's the yearly spend, not the quarterly spend. We do not break specifically the breakdown between OPEX and cost of sales, but you can assume that some portion is as well going to cost of sales as well.
Okay, and so you're not able to say. I mean, that's in my notes here. I'm not sure who I had spoken to. I believe Yonah, but most of it was SG&A. Can we even say that? Just to help us model. I guess it would be really helpful. It's a large amount and has a huge bearing on how everyone's going to model gross margin.
Yeah, the majority it is OPEX, but there is a portion also probably. There is a portion that goes to cost of sales. Okay,
and then how did your on-demand business do in the quarter, and how is that trending into through July?
Okay. Yeah. So SDM, it was down significantly this quarter, impacted mainly by those key vertical of fast of aero and auto, and The part business is basically indication of the economic overall. It's impacted by the overflow of orders. Customers are the first thing that they are doing is basically shutting down those overflow or any projects that are not necessarily. So that's why the part business is significantly impacted. It's too early to say whether we see business coming, whether the business is coming back in July. We see some signs, but it's too early, so we're cautiously optimistic in terms of how SDM going to look like in Q3 and in Q4.
There are no additional questions at this time. I would like to turn the call back over to Yoav Zeif for closing remarks.
Thank you for joining us. Stay safe and healthy. Looking forward to updating you again next quarter. Thank you.
This concludes today's conference. You may disconnect your lines at this time. Thank you for your participation.